Hello everyone and welcome to today's episode of Microcap Mania. Today is going to be our first ever portfolio update. Basically, as a lot of you guys are aware, earlier this year we actually started our Microcap Mania Portfolio. And over time I've been making our stock analysis videos, and if a company fits all of the criteria I'm looking for, I'll actually go ahead and add it to our Microcap Mania Portfolio. And now we've gotten to the point where we have about 80% of the funds invested. It's soon to be a little bit less than that, and I can get into that in a second, and I'm kind of excited to talk about that. But I thought it would be fitting to talk about some of the names that have been in there a while, give a little breakdown about what's happening in the actual portfolio itself, some of the returns, some of the big factors that have led to success in the portfolio, and then a couple underperforming names we have in the portfolio. So really quick, just from like a top level breakdown, our portfolio has actually returned about 7% overall. And mind you, this comes in a time frame where we didn't jump everything in on January and it's been 7% this whole time. This has been a slow, gradual process of finding names, and up until a couple months ago, I didn't even have 50% of the funds fully invested in the portfolio. So overall, I'm pretty happy with our 7% return. You know, it's not necessarily the S&P 500, and I think when we're dealing with smaller caps, specifically right now, a lot of the very tech-heavy trends we aren't going to be seeing as much success from in a microcap portfolio, and specifically one managed by me, who is kind of a contrarian value investor. But I am finding good opportunities and I'm excited to get into them. But first, I thought we should go ahead and start with some of the underperforming names, some of the ones I'm kind of upset with. So how this is going to work is I brought this up in our very first video where I outlined kind of the rules of the new portfolio. Basically, just because a company's underperforming doesn't mean I'm going to be looking to cut them right away, but at up until basically a year, as long as the company doesn't commit fraud or do something that is actually genuinely illegal, I can't just boot them out of the portfolio. And I'm really trying to hold myself accountable to holding something at least a year, and definitely a lot longer for the majority of companies if it's just because, the share price isn't seeing movements I like. But enough preamble. The first company on the list is actually going to come from my very first Microcap Mania video. That is going to be Snail Games. Now, at the time I made the Snail Games recommendation, I didn't actually have the fund in place, I didn't have the portfolio in place, I didn't have any of the ideas that, I would actually kind of add these to a portfolio. And so if I had been given the opportunity at the time, and even in a lot of the video, I broke down that it was very much a speculative position. And this is one of the stocks in the portfolio that over time, it's not just because, it's down a lot, and it definitely is down a lot. The management team is kind of taking it in a direction I wouldn't like to see. So overall, since we acquired it, it's down 46.2%, which is definitely a big jump downwards. And a lot of this really started where I kind of saw it kind of deteriorate was when they had their Aquatica DLC for their Ark Survival Evolved game. Basically, the first introduction to this was an AI slop trailer. There's no way to bat around it, no gameplay. It was definitely clearly an AI slop trailer, and this tanked the share price when people really caught on to this. And then they actually launched the DLC, and it was game breaking. Like, it just was not a good release for their DLC. It should not have been released in that state. It was genuinely kind of unacceptable, and it really ruined their product in a way. And now we have actually seen the company bounce back, but it's been haltered by the fact that now they want to transition into focusing into becoming a stablecoin company. Now, I think the best way to kind of put this into perspective is I'm going to read some things from their earnings report most recently. So the company, in a quarter where they had a 58% jump in units sold and over 20% jump in bookings, saw a $16 million loss. Now, how did they do this? Well, it's going to be from the increased headcount and the increased R&D that's going to come into developing a stablecoin, which I personally hate for Snail Games. I don't think they should try and enter the stablecoin space. There are already developed people there. And again, they have a product that nobody else on the market has and nobody else has really been able to replicate well. And there's massive demand for this. I mean, this past quarter, they saw a 58% jump in units sold. If they would just prioritize pushing out an actual date for Arc 2, pushing out quality DLCs like they said they were going to in their roadmap, and not deciding to pivot just into stable coins. Like, what's the point of pivoting when you have a successful business? I don't get it. I don't like it. I'm not feeling optimistic about the direction the company's going. That truly is the only position in the portfolio where I look at it and it just kind of upsets me. You know, a lot of the positions, if they're down by a little bit, they're down by as little as 10%. And that's something like, oh, I haven't had you that long in the portfolio. And again, this is a long term focused portfolio. But this one is something that I feel fully justified in saying I see the reasoning why the stock is underperforming. The second one that I have in here, and it's simply because of the amount it's down, I actually think the company's and the fundamentals are in an improving direction, is going to be gambling.com. Basically, a lot of what's happened with gambling.com recently is that expectations have just been sky high. And when you have expectations that are sky high, it's kind of hard to hit those goals. So, on paper, while you see the revenue growth, while you see how well the company's doing, and they're actually growing their EPS and they're doing a lot of things I'd like to see. And again, one of the biggest parts of my pitch on gambling.com was their acquisitions, and they have a lot of acquisitions they've made that have really kind of broadened their product portfolio from just this affiliate marketing to also adding different odds and statistics things. Overall, those things cost money. Those things aren't going to look good on GAAP accounting because it doesn't really account for future earnings. It's dealing with the right now and the present. And those are kind of some of the things that are hindering the stock performance of gambling.com. However, I'd say the fundamentals and the business itself are actually getting significantly better. So that's something I'm not worried about in the slightest. So those are really the only two companies that have actually, I consider, been established. I mean, it's way too early to, even with the snail games where I don't like the direction, it's way too early to completely write off the company. I'm trying to be a long-term focused investor and maintain a portfolio that really does think long-term. And in order to do that, you can't base things on a couple bad quarters. Now, moving over to our noteworthy good section, we have Potbelly Corporation, which is up 50%. Now, Potbelly Corporation has actually been acquired by Racetrack. They're in the process of being acquired by Racetrack for $17.11 a share, which is indicating a $566 million valuation for the acquisition. So, admittedly, this was one of the companies I brought up being an acquisition target. I just didn't think it would be this early on. And also, I didn't think that this would be the first company in our portfolio to get acquired. And if you had said it would have been by Racetrack, I would have been thoroughly confused because this is actually Racetrack's very first acquisition into restaurants or anything in like the food space. They're just a gas station company would be my first thought. And it's kind of a weird acquisition, but I'm a big fan. But again, this is one of the companies that it's going to be adding cash back into our portfolio, but it's for a very good reason because they are being acquired and we have gotten a large gain from them. So I'll be very thankful to Potbelly Corporation, assuming everything goes well in this acquisition process. The next really well established company in our portfolio that's done very, very, very well is Sega Technologies. And that's actually up 57 and 0.75% in our portfolio. Now, Seeka Technologies comes from my second ever stock analysis video for the Microcap Mania channel. And of course, that's dealing with the TPOX and kind of their product line. And really, where we're seeing a lot of success for them is not only in their EPS growth, and they've gotten more government commitments, which is really exciting to see. But I think a lot of this also boils down to the fact that when we got our hands on some Seeka Technology shares, it was really, 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 really undervalued. And not even just from the standpoint of, oh, this has future growth opportunities and that's why it's undervalued. Like, we're talking low single digit PE ratio for a company that had almost its entire market cap in commitments and in like outstanding orders, which I love to see. And then also they have a very large cash position, and they still do, and they have zero debt. So this is really, they're still actually cheap on paper despite having a 57% increase in the stock price, which is kind of crazy to say, but they have all of the things we'd like to see, and they have a great balance sheet, and they can kind of go any direction they really want, and that's the companies I like targeting in the portfolio. Now, a couple companies that I feel haven't necessarily been long enough to get like a full breakdown, but have actually contributed a lot, has been Turtle Beach. And the Turtle Beach one, a lot of that is just coming from, I think, a recognition of the value of Turtle Beach. Again, another company we got for really, really cheap. And then Lifeway Foods, which I actually, if you would ask me what the first position in our Microcap Mania portfolio would be that would actually end up being acquired, I would have said Lifeway Foods, because they've been in this back and forth of almost getting acquired and getting offers that have now turned out to be way too low, even considering where the company is currently trading. And so I still definitely see that as a potential opportunity for them to get acquired and be added into a brand, and being the dominant player in kefir. And I've actually, what's funny is I started, the first time I ever tried their products was right before recording my Lifeway Foods actual valuation video, just because if I saw all the great things, I did all of that stuff on like the stock side, but if I hated the product and I thought it was terrible, I don't want to invest in that. I want to invest in things I feel confident in, and I feel confident in really great tasting products. And obviously, something being really healthy is going to carry in that factor, but I've actually continued to be a customer of Lifeway Foods post that video. It's kind of funny because I feel like it's definitely helped a lot with like digestive stuff, and it tastes significantly better than kombucha, which I remember going on a whole ramble about in the actual video analysis. So that's kind of the more important contributors to our portfolio currently. Again, I feel quite optimistic actually in terms of where the portfolio is right now and where I think it can potentially go. And we're already seeing some of the things I love to see in the micro cap space happen in, quite frankly, a lot shorter of a time frame than I would have thought. We are already having a position being acquired. That's a really cool thing to go through. And hopefully over the next year, after we kind of, I think it's quite likely that I finish out our initial round of investing in companies, and then we're going to kind of do a breakdown of, now that we have these companies, we're going to create a numerical scorecard for each company, and then we're going to see if I find opportunities that I believe are better fitting than the companies we currently are holding on, then we'll make changes. But if not, and it's going to be kind of a high bar, because I want to eventually end up with a portfolio that I feel like fully confident in each and every position. And I know that's a very hard goal to set for myself, but I think trying to prioritize low turnover is going to definitely benefit me. I mean, it may not be necessarily the best for content creation because I won't always have something to necessarily harp on, but I want to live by example the principles I teach of long-term investing. And so that's a good price to pay, I would say, is leading by example on that front. So overall, I'm happy with the state of the portfolio currently. We are in a bit of a frothy market situation. Now, I know there are some markets internationally that aren't as frothy, and there are opportunities there, and I'm really trying to research and find some good opportunities, but I will say one of the hard parts with this space is it really is a lot like finding a needle in a haystack. And already kind of drawing some conclusions I found when looking at our portfolio and what's doing well versus what's not, I'm finding that a lot of the companies that are really doing well are the more value picks, whereas the more speculative picks aren't necessarily seeing the performance that I'd like to see. And a lot of that probably does come down into the selection process. I'm trying to be open minded and learning in my process of actually selecting the companies that go into the portfolio. And it makes sense with my background and who I'm trying to aspire to be as an investor that I'd be a much better value investor than trying to pick speculative positions because that's not really something I'm interested in investing in the first place. So, overall, with those in mind, I'm going to continue to try and find stuff, even though we're in the midst of a frothy market. But I'm also coming to terms with the fact that we will likely see some corrections in some way, shape, or form. But so far, we've survived it, and I think the portfolio is really just overall in a great spot. So yeah, thank you for checking out today's video. I hope you had fun kind of listening to a breakdown of how the portfolio is going and how I'm kind of viewing our process. Right now we're still a little bit in finishing out our selection process, but we're going to be going into more of these types of videos where it's going to be more updating and monitoring and making sure that the companies that I've picked ownership shares in are actually doing the things that I selected them to do. So overall, thank you very much for checking out today's video.